Hi everyone, and welcome to episode 121 of the Rewarding Property Decisions podcast. So, to quote the great Eddie Maguire, well, he's not great to me, but what a big week it has been in property this week, not football. But obviously there's been plenty of discussion. The federal budget was released last week by Jim Chalmers, and there's been a lot of impact on property market, particularly on investment properties. And obviously that's a big talking point for our podcast and for our business. So we wanted to give our insights today on those releases, focusing predominantly on the negative gearing and the capital gains tax sides of things. I'm not going to go into the nitty-gritty about what it is and what it means because no doubt for anyone that's had any interest in property, you've probably read it multiple times over the last few days. So we'll focus more on some of the outcomes and perhaps some of the unintended consequences that may come to light by some of the releases. But I'm very privileged today to be joined by Jordan Telfer. Thanks for coming, Gordo.
No troubles, Jarrod.
So we'll get straight into it. I'll just give you a quick overview on the two main points and then we'll get into our thoughts. So from the 1st of July 2027, losses from established residential properties will only be deductible against rental income or capital gains from residential properties. Now, this applies for any purchases of established property after 7:30 on the 12th of May 2026. Properties purchased prior to this time, even if they're not settled, are still entitled to negative gearing. And any brand new properties purchased off the plan beforehand or going forward will still be entitled to negative gearing. Properties purchased after the 12th of May and prior to the 30th of June 2027, established property will be entitled to claim negative gearing benefits up to that 1st of July 2027 when things will kick in. From a capital gains tax perspective, from the 1st of July 2027, the current 50% capital gains tax discount will be scrapped and replaced by an indexation for assets held for more than 12 months. There will be a 30% minimum tax applied to the real after indexation. And this will apply to all capital gains tax assets, including pre-1985 assets. For brand new properties purchased, you'll have the choice of either the new model or you can retain the former model of the 50% discount. So for any properties purchased up to the 30th of June 2027, the 50% will still apply. So that's the main overview. Anything that I've missed there?
I don't think so, but I tell you, this is like one of those choose your own adventures as a kid where it's not complex. The treatment isn't complex, but it is even more now. Every person's individual circumstance is going to be entirely different from the next. Yeah. Whether you can just cut and dice it so many ways. And this is where probably the main thing we probably need to express and get across is that it's right now. Yeah. We've got our thoughts as to what could eventuate, as you indicated. There are always going to be unintended consequences from any major change. And if you put it into football parlance, as I mentioned last week, AFL brings in a law to counter coaches' tactics, and coaches
figure out
a way around things, I suppose, or manoeuvre through the new environment. Yeah. And in this context, I suppose, AFL's the government, and the coaches are financial advisors and clever accountants. Who will work out the path of least resistance for the clients.
Yeah, and what's the best structure for that person individually. All right, so what does it mean for current investors? Let's start with that. So those that already own established property, what should they be worried? Is there anything for them to worry about?
Those that currently hold established property, well, they're probably in the best position of anybody just to stay put. All the provisions are grandfathered, so to speak. So if you negatively gearing a property today, you'll be able to negatively gear it in a year's time. Yep. Obviously, then the thought process from somebody holding an existing property at the moment is, well, that's well and good, but is the established property market going to drop away to the point where if I want to sell at some point within this new regime, are the guts going to fall out from the value of my property? Yeah. We'll delve into that a little bit deeper. I don't think it will.
No, well, I mean, and again, it depends on the type of property that you've purchased.
And that's the other thing.
What your focus has been, whether or not you've followed certain criteria and certain requirements, but if you've got a property that has got that multifaceted demand that we talk about, things shouldn't drastically change over the long term. Over the short term, yes, it might mean that perhaps some investors, probably less so in Melbourne, and again, we'll get into that, but In some of the other capital cities, it's possibly going to, because in the short term, you may take out a larger portion of the market. Whereas in Melbourne, we haven't seen investors being overly active for a considerable period of time.
Yeah.
So I think from an immediate impact perspective, I don't see it having a great deal. It might take a bit of confidence out and it might remove a few. There's definitely some investors. We've been working with plenty, but not necessarily, it's not a driving force in the Melbourne market at the moment.
No, it's interesting, isn't it? Because, I mean, it's probably not quite as dramatic as what this analogy sounds like. But when you compare Melbourne to the rest of the country in the last few years, well, when you're on the canvas, you can't fall much further, can you, really, in the Melbourne market?
Yeah.
It's held its own, but that's all it's done, which has been poorly compared to other capitals that have actually seen some significant growth.
Yeah.
Just holding your own and maybe doing a bit better doesn't cut the mustard.
No.
The reason for that, though, a factor separate to what the rest of the country has experienced. So that's really, we're not going to go into too far in it. We're a long way out of COVID now, but that probably started the rot.
Oh, it did.
But then more to the point, investors have started to, or had been removing themselves slowly from the market in response to new regime changes, tax changes, tightening up of Residential Tenancies Act requirements at a state government level, which, from my understanding, some jurisdictions, other states are sort of starting to borrow a little bit from that as well. So it hasn't been as reliant, at least the established sector hasn't been as reliant in Melbourne on interest and competition generated from investors as other markets.
So there's another layer coming on top, though.
And and when you consider, well, investors aren't active in the the higher end home buyer owner occupation market anyway. You don't find people competing for investment purposes at $4 million properties.
No.
And likewise at the entry level, our experience, and certainly talking to agents in the areas that we operate in, investors, there are a few, but they certainly aren't driving the market.
No.
It's the first home buyers in that sub sort of $800,000-$900,000 range that are driving it anyway. So it's not as if a big exodus of investors, it's not as if there's a lot of investors there to exit the market in big
direction.
Numbers, to materially affect it. So Melbourne could be a very interesting contrast to the rest of the states.
So what about for future? So going now that for people that were considering whether they were actively looking prior to the budget or whether they were intending to buy an investment property at some stage in the next 12 months, 2 years, 5 years, what are we thinking there in terms of what should they do?
My view is probably a little bit, well, maybe not conservative, but it's if you're intending to buy before last week, if you're intending to sell for personal reasons and you're reaching retirement, you want to put your money into a different asset or whatever it might be, go for it.
Yep.
But I wouldn't be making any decisions, knee-jerk reactions based upon what we saw last week. We saw people panic, and understandably panic, because after COVID, or as COVID hit, we were worried about the direction of the world. Are we going to be locked down forever? Is there going to be vaccinations? Are we ever going to remove ourselves from this? And we had clients that were wanting to jump in very quickly to sell their assets. For certain clients, it made sense. They were probably bringing forward the decision as they were approaching retirement anyway. In a few years' time, they wanted to bring it forward, worried about the market, the floor falling out of the market. As it turns out, it was probably, certainly in the short to medium term, probably not the wisest thing to do, as the market did, even in Melbourne. It did bounce after that initial shock wore off. And it was significantly bounced. So I'd probably be inclined to say, look, unless there was a pre-existing strategy, I suppose, before last week, I'd be just holding fire. I certainly wouldn't be selling out of existing assets.
It's more, but I guess rather than talking about what selling out, it's more, I guess, is more about for the new people coming in. So, and given that there's been some extra support for new builds, and that's certainly the encouragement that the federal government seems to be going down is, okay, for we don't want to put investors out totally, so we'll still give you the negative gearing options for brand new properties. We've obviously always flagged that as as something to be very, very cautious around and not to be focusing on that purely. But that's going to happen, isn't it? People are going to, potentially those that may be too tax focused and not necessarily wise to the reasons why they may not be good investments, are going to get caught up. And I've said this to a few people. The budget was announced on Tuesday the 12th. On Monday the 11th, when the media started really heavily reporting on the off the plan, or that negative gearing would still be available to brand new purchasers, the spruikers started. I received an email Monday morning telling me how wonderful this was going to be, that we've got all these wonderful properties for your clients. You should be buying this. They'll get all these benefits. The market's going to fly. Get involved. And that was the first before the budget had announced. And then I got another 2 or 3 later that week. And we get those every so often. Financial planners typically get them more often than we do.
Yeah.
But if they're already starting to fly, they are going to come out of the woodwork. And that's a real concern, because, we spoke about this when this was, and I spoke to Richard about this when it was a big thing for Bill Shorten back in 2016 and 2019, that our concerns at that point in time were that you are encouraging investors to buy the wrong property for the wrong reasons. And it's basically the government using property investors to fulfill their promise of building a certain amount of properties. And investors need to be aware of that's the objective here. It is to build more properties. It is not to support investors.
Yeah.
So it might be an incentive, but it is not going to be and we'll get into this in a minute as well, but the negative gearing side of things should be an added bonus to buying property. It doesn't create you wealth.
And we've been saying that for 30 years.
Yeah.
It's the cherry on top. It's the icing on the cake, but
Yeah.
it's not the driving reason. By all means, explore the opportunities that are available in the new build sector.
Yeah.
But you still have to apply the same fundamentals and the same questions.
Yeah.
Where is the demand coming from? Where is it likely to be when I want to sell? And what is the likely supply-demand equation going to be? Is it going to be an imbalance in my favour, so greater demand than there is supply, or is it going to be the opposite?
Yeah.
And that should be the driving force.
Yeah.
I fear that it won't be. It will just, the same mistakes will be repeated.
Yeah, and it is a concern. I mean, I think the support for first home buyers is one thing, and giving them opportunities. And we've certainly seen that the 5% deposit scheme has been certainly taken up. And from speaking to mortgage brokers, that has had a significant impact on giving opportunities for people that otherwise wouldn't have been able to get into the market. So that was working quite well. The supply side of things is definitely something that needs to improve. But my concern is that it's done at the expense of wealth creation, and that's the idea of investing in property. It's not for tax benefits. It's to create wealth to set you up. And if you're buying an off-the-plan property, whether it's an apartment, whether it's a house land package, and the bulk of what you're buying is at its absolute peak with minimal land component, and it's going to be going backwards in value, the negative gearing benefits that you're going to receive, and you certainly won't be having to worry about the capital gains tax because you won't be getting any.
Yeah.
So moving on, I guess we sort of touched on it before about Melbourne, and how will this impact the Melbourne market. As we said, we don't think it's probably going to have a drastic impact. It might have in the short term. There'll be a few people that'll sort of step back and just say, hang on, what's this all about? Which is human nature. And we see it at the lead into a lot of elections too. People, hang on, I just want to wait and see what happens. And that's fair enough. You're making a big decision. You're spending a lot of money. You need to hold back and make sure that it's for the right reasons. Yeah. The other thing is that I've heard a lot of people say, which I think is exactly right, is that this is not legislation yet. And this has not been ticked off. And yes, and most of this will possibly go through, but it's not going to go through in its current form. It will change in different ways. It might only be minor, might be significant. Yeah. But there'll be changes. So don't necessarily just jump head on in or jump head on out because you're concerned about something, because things will be different. And there's ways and means that you can handle this, but taking a breath is always advisable.
Yeah.
So I think as Jordan said before, the Melbourne market will probably suffer less because, as you said, it can't go much worse. I mean, don't get me wrong, it can go backwards, but it's been pretty flat and pretty basic for a while now.
Yeah, years ago it was that dynamic and that competitive tension between home buyers and investors.
Yeah.
and we certainly saw that,
Yeah.
and participated in it
Yeah.
to a degree. I mean, we act for investors,
Yeah.
but we weren't alone there. Investors have certainly not been nearly as active as what they were, 10 years ago, 15, 20 years ago, but it's been backfilled to a degree.
Yeah.
It's opened up the opportunities for younger home buyers. For other markets have probably emerged a little bit in that people who have, perhaps peninsular properties or country properties need a Melbourne base.
Yeah.
People that are downsizing. There's opportunities there that people are taking advantage of as downsizes into sort of a smaller, more closer into the city house. So
Option.
there's a breadth of demand, I suppose, that may not have been there actually 20 odd years ago when it was pretty much home buyers and investors.
And that was about it.
Yeah. But again, it points to the fundamentals of the property and that breadth of demand.
Yeah.
Yeah.
Okay, so are there going to be some opportunities or things that perhaps aren't being talked about? There's been a lot of negativity around this, and it's poor investors, poor this. Are there going to be some opportunities? And again, as we said, there's a lot that can change here, so we've got to be very mindful of not putting out there things that will happen or won't happen. But are there things that potentially could, or that haven't been spoken about, perhaps that we think probably need a little bit more focus on them?
Well, interestingly, and again, I'm very wary not to wade into territory that's more for accountants and financial advisors, but with a lot of the media commentary of the last week, what's been skirted over is there are still some advantages.
Yeah.
They're not as direct, but the ability to carry forward losses.
Yeah.
If you can absorb them to start with and be able to carry them forward. Now, they were always there, but you don't carry forward a loss if you can immediately offset it against your salary income, which was underpinning negative gearing.
Yeah.
Now that's removed. Well, suddenly the spotlight gets shone a little bit on that ability to carry forward losses. So if you end up in a situation at the end of the financial year where, well, okay, I've had outgoings of, with your interest and your holding costs of, say, $35,000, and I've brought in $15,000 of rental income.
Yep.
Well, that $20,000 can't be offset against your salary anymore. But when that property turns into a positively geared asset, which ultimately should be the aim anyways, to pay down the debt, that $20,000 can be then offset against years when you do have positive cash flow, so to speak, or at the point of sale to minimise your capital gains tax.
And I guess the other thing you could look at too, and we have this conversation quite often, clients come in and say, I don't want negatively geared. It needs to be neutrally or positively geared. What do I need to do? And this differs depending upon interest rates and depending upon cost bases and things, but it might mean that instead of leveraging as highly as you possibly can, perhaps it's more at a more middle level, if you've got the capacity, obviously, because that's a big part to that, to get it more neutrally geared earlier so that you can carry forward those losses sooner. Yeah.
Now, that won't be for everybody, because it's all very well to say this
100%.
in theory, but that still means probably tipping in, well, perhaps 50%.
Yeah.
And that's a significant amount of money.
Yeah.
Even on what we would term as an entry-level house in a suburban Melbourne area, well, that's $500,000.
Yeah, it's a lot of money.
It is a lot of money.
But for some people, and this might be a case, and again, unintended consequences, but perhaps this becomes a bit of it starts to be the haves and the have-nots, and those that have got a greater financial capacity are still able to invest in property and perhaps are in that area, where those that perhaps in the past would have still been able to with the leveraging now can't.
Can't do it.
So that, again, it might take away another option from wealth creation. The thing to always keep in mind too is with the capital gains tax, it's not a property tax. This is an investment asset tax. So the capital gains tax implications are across the board. It's not just property there. Yeah, look, it'll be an interesting one, won't it? I mean, property is still going to be, it's very attractive to a lot of people. Some people just are obsessed with it. They do not look at anything other than, and we've always said again that a balanced portfolio should not just be property. It should have some form of super and shares and all those sorts of things as well. And I still think that property needs to form part of it, but it might not be as straightforward and may not be as easy for everyone as what it has been in the past. Yeah. And the other thing that's probably been talked about a little bit is do people start to really focus on putting a lot more and perhaps even stretching themselves more on the family home?
Yeah, and that's what I was about to raise actually, because that's one of the few assets now, I suppose, that are quarantined, for want of a better term, from these taxes.
Yeah.
No capital gains tax on the family home. So I think there could be a bit of that as well.
So you stretch yourself and basically put yourself into a really higher end property to then perhaps downsize or something down the track, so that you've built up that equity that way, and you can then, when you need to, you don't need to be in that sort of environment anymore. You can go to something smaller and use that cash for something else.
Untaxed cash on the way out. In terms of opportunities, though, Jarrod, just to probably put a full stop to that there. Question, I think that increasingly in the established sector of the market, it will be trying to find that property that has, again, that what we always come back to is that broadest possible demand base.
Yeah.
So that might mean that property that has those opportunities, not necessarily for you as the first investor to unlock, but when you come to sell.
Yeah.
10, 15, 20 years. So a way to value add. So that could mean an undercapitalised property. So good, very good location, good size land, but the house itself.
Depreciation benefits come into play too then if you start to do things too, which can certainly, and it gives you a good way to increase your rental yield. Generally, if you do it the right way, you can get good value for money and return on investment on that sort of thing too. Yeah. And that's not necessarily needing to be the person that, I mean, I'm certainly by no means a handy person, but if I was buying something tomorrow, I would be looking at something that I could add value to and not just be reliant on the market. Then finally, so I guess just wanted to final on the what we think versus the new versus established, because that's obviously a pretty key part to all of this, and it is a concern that I've got, is that there's a real push towards brand new property. Do you see there being concerns or people going into that brand new property for the wrong reasons, and what are some of the risks that they're going to have?
Well, the one that is glaringly obvious, and this struck us on Wednesday morning, and has been raised in various opinion pieces we've read over the last week, is that a pure focus on the tax benefits that accrue to you will not be, as the seller, in purchasing into a new property. They won't be available, they won't be transferable to the next person. Suddenly it's like that car that gets driven off the showroom floor. As
soon as it's
hits
out
the road, it you can take a third of the value off or whatever it might be. Then and there. So again, to my point earlier, is that you need to then take a step back and say, well, that's the reality. People aren't going to be lining up for my property as I lined up for it, because they can't take advantage of these tax benefits, and they can't take advantage of any depreciation, because me, as the first purchaser,
all that.
I use that, can't transfer it. So does the property have the underlying fundamentals to maintain its appeal in that marketplace? And if it does...
To an owner-occupier, basically.
To an owner-occupier. Or is that owner-occupier going to come in and look at my property, and they're going to see another dozen that were built at the same time, offering similar standard of accommodation, now similar condition, and they've got the choice between one of 12 second-hand, so to speak, properties, or are they going to say, as I did, well, that's well and good, but I'm going to avail myself of the brand new one, be it in a new building that's popped up, a medium to high rise, or in a new estate, or whatever it might be. And you run that risk. So the fundamentals, again, we come back to that supply and demand and the fundamental appeal of that property to the market.
And I think the other thing with that too is the prices that will be paid for some of these off-the-plan purchases too, because we already see that with an off-the-plan purchase, there's a developer's premium factored in, because they need to make the profit, and they're doing it to make a living. So there's a developer's premium for that. There'll be an investor's premium, because it'll be a case of, well, we've got these investors now wanting to come in and they want the negative gearing and they want the depreciation, so they can leverage further than what other buyers will, so we can charge more from that perspective. They'll then start factoring in rental guarantees, and they'll give those, which will only last for a certain period of time, and then as soon as that rental guarantee is no longer there, the yield will drop significantly. So they'll disappear as well. And then there'll probably be other incentives. So all of a sudden, there's justification to start paying high prices for some of these properties that even when they're brand new, others wouldn't have paid that for them. And then once you take those buyers out who can't get those benefits, it comes back to here as a starting point, and then it comes down further. So there's some real concerns around the modern side of things and what people might get caught up in buying. And everything looks good on a spreadsheet. In terms of this is what it'll do, and this is what we expect the performance to be, and rah. Plus, you get all of these benefits and all of a sudden it looks fantastic, but is it actually going to play out that way? So,
historically speaking, it hasn't.
No, so that's something for people to be very mindful of. So look, a lot to take in. Thanks very much for joining me, Jordan. It's been really good. We'll probably be doing some things on this at different stages, and probably a few more deep dives over the coming months, I would say, as more information comes to light and there's a bit more clarity around what may or may not change from the federal budget. But again, thanks for joining us. That's episode 121. If you'd like to share the podcast far and wide, please subscribe to all of our YouTube channels, podcasts, those sorts of things, and leave us some lovely reviews. Otherwise, if you'd like further information, visit the website wakelin.com.au, and otherwise we wish you all the best with your property decisions.